Hello there, everyone. I'm attorney Kelly Longtin from Kelly Longtin Law, and today I want to talk to you about trust scams and how you can spot them. Now, trusts are widely used in estate planning to protect and transfer a person's assets, money, accounts, property, things along those lines, and sometimes in a tax advantage manner. Now, some trusts are highly complex with multiple parties and intricate structures, specialized legal terms, and references to arcane tax law that can be difficult for the average person to understand. Now, scammers have long taken advantage of this complexity to dupe taxpayers into too good to be true trust solutions. The Internal Revenue Service, the IRS, recently drew attention to a trust tax avoidance scheme involving what are known as 643B trust. It also warns about another type of trust scam that relies on the so-called pure trust or constitutional trust to make false claims about avoiding taxes and protecting assets. While legitimate trust can be powerful tools for estate planning, asset protection, and tax efficiencies, fraudulent trusts misuse these principles to deceive individuals. The IRS pays close attention to potential trust tax evasion schemes, and taxpayers who fall victim to a trust scam could potentially face civil and even criminal penalties, making it crucial to create a trust only with a qualified, reputable estate planning attorney. According to the IRS, in the past few years, there's been a proliferation of abusive trust tax evasion schemes targeting wealthy individuals, small business owners, and professionals such as doctors and lawyers. These schemes falsely promise benefits such as the reduction or elimination of taxes, reduction or elimination of income subject to tax, depreciation deductions, and a step-up in basis for trust assets. These trust scams commonly use a layered structure to give the appearance that a taxpayer does not control the trust when in fact they actually do. Transparency of control over trust assets is important in determining, among other things, which party is responsible for paying any corresponding tax liability. The IRS also notes that abusive trust schemes frequently entail multiple trusts that distribute assets to one another. Trust funds may flow from one trust to another using rental agreements, fees for services, purchase and sale agreements, and distributions with the goal of using inflated or non-existent deductions to reduce taxable income to nominal amounts, says the IRS. Trust scam promoters typically charge $5,000 up to $70,000 for a package that comes with trust documents, trustees, and tax return services, adding to the appearance of legitimacy. However, the IRS cautions that these phony trust arrangements will not produce the promised tax benefits. So let's talk about the pure trust scam. One type of trust scheme highlighted by the IRS involves the transfer of a business to a trust. It calls a pure trust or a constitutional trust. The pure trust scam makes it look as though the taxpayer has given up control of their business, even though they still run its day-to-day activities and control the income stream. Promoters of such scams often claim that placing assets in a pure trust can exempt them from taxes. There's misleading language and pseudo-legal jargon to make it seem like these trusts have special legal status and may claim that they are based on common law or constitutional principles, exempting them from state or federal jurisdiction. However, the IRS clarifies that there is no legal basis for these claims. Actor Wesley Snipes is a notable example of someone misled by a variation of the pure trust scam. Snipes relied on an argument that courts have repeatedly rejected, the 861 argument, which misinterprets Section 861 of the Internal Revenue Code to falsely claim that domestic income is not taxable. The IRS alleged that Snipes did not file tax returns for several years and committed fraud. He was convicted of tax evasion charges and served time in federal prison, in addition to owing back taxes, penalties, and interest. Let's talk about 643B trust scams. Versions of the pure trust scam date back decades. Despite increased awareness of these scams and the IRS pursuing them in their various iterations, they continue to resurface, often rebranded under different names such as Complex Trust and Patriot Trust, or targeting new demographics. The IRS details one such rebranding of the Pure Trust scam in a 2023 memorandum challenging trusts that similarly and just as falsely claim to avoid income and capital gains tax. Promoters assert that these trust arrangements receive special tax benefits under the Internal Revenue Code 643B, hence the name 643B Trust. The IRS refers to them in the memorandum as a non-grantor, irrevocable, complex, discretionary spendthrift trust. A complicated name for a complicated scam, like the Pure Trust scam, relies on a misinterpretation of the tax code that takes it out of context. Although 643B trust scams take various forms, they're essentially a new twist on the old idea that through manipulation of the trust structure, the taxpayer can use a backdoor method to maintain some control over the trust and to avoid taxes. The basic but false premise of the 643B scam is that income allocated to the corpus or the principal of the trust is not subject to taxation. Now, promoters create a trust structure often referred to with terms like non-grantor, irrevocable, and complex. The taxpayer transfers assets such as a business, real estate, or other income-producing assets into the trust in exchange for a promissory note. The trust then leases the assets back to the taxpayer, an arrangement that makes it seem like the income generated by the assets is not actually being distributed to the taxpayer and thus non-taxable. The IRS explicitly rejects the validity of this arrangement in its memorandum, emphasizing that simply allocating income to the trust corpus does not exclude it from taxation. Now, the IRS has made it clear that it will challenge 643B trusts in all forms, so taxpayers should look out for this and other trust schemes to avoid getting caught in the government's compliance crosshairs. As noted in the IRS memo, illegitimate trusts that misinterpret 643 often hide the guise of legitimacy and may even have legitimate appearing promoters such as lawyers, accountants, and enrolled agents. Promotional materials may consist of a series of presentations, informational websites, documents, and legal opinions. In the case of a non-grantor, irrevocable, complex, discretionary spendthrift trust, the trust may be described as 643 compliant or in compliance with the IRC, Internal Revenue Code. More generally, taxpayers should be on the lookout for these common trust scam red flags. First is exaggerated claims. Taxes are as unavoidable as death for a reason. No legal trust strategy can entirely eliminate tax obligations. Claims about deferring taxes instead of avoiding them may sound more reasonable, but could be part of the scam. There's also secret loopholes. While tax law is complex, it is not a secret. Legitimate strategies are based on established legal principles. Scammers also like to tell potential victims that wealthy individuals use certain trust types to avoid paying taxes. You also want to be on the lookout for terms that give an air of legitimacy. Trust schemes may reference and misuse terms such as common law or sovereign to promote trust as beyond the legal jurisdiction of the federal government. Taxpayers in the 643B scam are told that they will serve as compliance overseer. There's also pressure tactics. In a classic scammer technique, trust scheme promoters may push individuals to act quickly to secure this exclusive opportunity and create a sense of urgency that pressures them into making a rash decision without fully understanding the consequences. You also want to be on the lookout for complicated and confusing structures. Trust, tax, and estate planning law are inherently complicated, but complexity can also serve to hide a scam. Multiple trusts with confusing names and structures can be a way to obfuscate the true scheme's true nature. Also, a lack of transparency. Promoters may be reluctant to provide clear explanations or documentation about how the trust works. relying on anecdotal evidence or testimonials other than facts and legal analysis. Similarly to known scams, many trust scams are the taxation equivalent of old wine in new bottles. Learning how to spot a scheme and cross-checking a trust strategy against known scams, including those in the IRS Dirty Dozen and other public warnings, can reduce vulnerability. Above all, avoid promotions that just sound too good to be true. Verify the promoter's credentials and always seek a second opinion from an independent estate planning attorney before creating any trust. So I hope this all helped you to just be on the lookout for some potential trust scams that are out there before you enter into a trust that just sounds too good to be true. I want to thank you for watching. I'm attorney Kelly Longtin from Kelly Longtin Law. Please like and subscribe our page below if you want to learn more about estate planning.